We have with us none other than Dhirendra Kumar from Value Research joining in on the show right now. Dhirendra, hi, good morning. Great to have you in ET now after a long time. Dhirendra, just wanted
Yes,
to
it has been
understand,
long.
debt
Thank
as
you.
an asset class is getting so attractive given the kind of interest rate scenario that we are in currently. Is it an obvious choice right now that in this uncertain time with equities, you've got to have a larger exposure to debt?
Not really, any thoughtful investor should have an asset allocation plan. So if you don't have any, uh, write one for yourself. And of course, it's a good time to be investing. If, your debt exposure will get a decent return. But I think more importantly, the way to rebalance, the way to review it will be the interest rate has gone up from 4 to 6.5%. And what the home buyers have not understood that their home loan has got elongated from 20 years to 29 years. So take a stock of things. You might be lent because when you buy debt, when you invest in debt, or fixed income, you are effectively lending, and your own borrowing has gone up. So it is time to take a stock of things, realign things. And if you don't have asset, one investor should not be a binary investor that is it should be in equity or should be in debt, because it is very hard to call that, take a call on that. If somebody can do it, it will be a magic, but very difficult to do it. And we have seen in the last 4 or 5 years that nobody has been able to get their call on the interest rates well. Most fixed income professional fund managers have not been able to call it right. So I would say that have your asset allocation, have a rebalancing strategy, but before that, take a stock of your borrowing as well.
I understand that, Dhirendra. I mean, no one can time it to perfection, and given how short cycles have now become, you don't know what's going to happen next. But assuming that you want to have exposure and you want to diversify into debt, many wonder whether even a simple FD today is going to give you better returns than a debt fund. For those within the debt category, what is it that they should be doing?
Any passive long-term fixed income investor should not try and venture into the novel part, or the exotic part of the fixed income market. Though if you have a predictable time frame for which you are investing, then you have a lot of interesting. Even fixed deposit could be a decent thing. But one should look at the post-tax return, and there we are getting some very handsome return. But post-tax it may not be attractive. The advantage of a fixed income fund is that you are able to defer all your taxes till you realize it, and converting your interest kind of income into a capital gain and effectively a lower tax rate. So with that in mind, and the interest rate outlook is going to be very hazy from here on. It is not going to be a very linear one, upward or downward. There might be expectation that it will go up and it will come down, or it will come down and it will go up. So uh, it isn't a very clear path as it was a year ago. So with that in mind, I would say that investors should not get venture into anything but short-term debt.
Sure, Dhirendra, that point is taken, but also wanted your sense regarding this latest investment avenue which has opened up, which is municipal bonds as well. We saw quite a bit of, heavy subscription and interest coming in from the retail investors as well. What would be your recommendation around that?
Be careful about it, because when you are buying municipal bond, you have to see the quality of that. It is fine to be, there is a novelty. They are yielding decent return. They have a cash flow backing it. But all municipal bonds may not be alike. So one should be looking at what you are getting into. It may not be, and today investors don't have the avenue of diversifying into them. So if over a period of time we have options, we have choice, and somebody is able to diversify it well, because taking this route, just don't get attracted to high return, because your capital might be at risk. Be wary of that.
Right. In terms of, just investing for long term in the balanced fund, would that be the correct approach? Because the fund manager, depending on the rate in the fixed income, would actually make those adjustments?
Yes, absolutely. The automatic rebalancing without any tax incidents makes these hybrid funds very attractive. Depending on your, balanced fund, the erstwhile balanced fund, which is now called aggressive hybrid fund, they are very interesting because they are almost like an equity fund and they are able to rebalance. That is meant for long-term investors, long-term, equity investor, and they get the automatic rebalancing without any tax incidence. That is one way. We don't have a decent choice of the 50-50 balance fund. But the equity income fund or the conservative hybrid fund, where nearly a fourth of the money is invested in equity, three-fourths into fixed income, that might be very useful category today for any conservative long-term fixed income investor or risk-averse investor.
Dhirendra, a lot of these, guaranteed maturity option funds as well are available, or schemes are available out there. I mean, a case in point being, HDFC Life Sanchay Plus, for instance. Of course, there is that sizable lock-in as well, but they are giving you maximum, rate of return at this juncture. And similarly, I can pull out many other schemes as well. What do you think of those plans?
I'm very apprehensive about it, and I'm unable to relate to what you're referring to, the Sanchay Plus.
Right. Dhirendra, you earlier had spoken about balanced funds and, as you said, that automatic adjustment is good. I'm sure over the years you would have asked these questions a lot of time, that over the long run, does a pure equity fund do well or a balanced fund? Have you done some analysis? Because I had done it somewhere back in 2013 where it really pointed out that balanced fund over a period of 6-7 years tend to match returns of equity. Is that something which you have seen in hindsight?
Yes, we have seen there are occasions when balanced funds are able to beat the equity fund category by a handsome margin. Well, that is entirely because a quarter of the money, in a falling market or in a heavy market or in a market which is going up and down and not going anywhere. That's the phase when balanced funds do very well. But as you know that, equity does very well. In a very narrow period of time. It could be a test of patience for a long period of time, and then it goes up. The big spurt that happens in a small time period, that actually makes the case for equity. So I think, it is not balanced fund or equity. The case is that, if you are not used to the equity volatility, if you are not used to 20%, 30%, I don't know how many of our viewers today will recall 2008 or post 2008 market. The market went down by 70% or 65%. The Sensex went down from the high of 20,000 to 8,500. That was the time when small cap funds went down by 70%. Large caps went down by 45%. That's the kind of thing which many new investors or and somebody who has not been a regular fixed, or anybody who has not experienced with market-linked investment might be driven out of the market forever. I think balance, the aggressive hybrid funds or the balanced funds are meant for them. It helps you stick around. But if you are used to it, if you can actually take it into your stride, then the numbers are very clear. Small caps do deliver best return over 10-year, 15-year period. The returns actually get enhanced if you are a regular investor. But the big drawdown that we see in between, that is where these funds come into play, and they also happen to be most tax efficient. One should not be doing all this rebalancing. If you have to do the rebalancing yourself, which is not very difficult, but it may not be very tax efficient. And more so now when equity is taxable.
Dhiren, also just wanted to understand, interest rates play a very important role in your portfolio of balancing. We've seen a rapid increase in interest rates, and suddenly the view is that, the rate hike may stop, or, going into next year, you may see some sort of cuts coming in. When such rapid changes happen, is it advisable to just follow one strategy or keep changing based on the increase in the rate?
It is very difficult for an individual investor to keep changing strategy and making sense of all this. And that is also at a time when because most of the changes that happen, they are not predictable. So I would say that managing the manageable, you have a greater sense of when do you need the money, how much decline that you can withstand, what are you comfortable with. And this is where this asset allocation, a disciplined approach, rebalancing rules for yourself is more implementable. if one is able to predict these precisely, one could be a magician and actually could be very rewarding.
Oh, well, absolutely, Dhirendra. We'll let you go on that note. Thank you so much for joining us and talking
Thank
to
you.
us about how the entire debt allocation could be for investors at the moment. What's the best way of doing that? And more importantly, what are the things that you need to be watchful of and wary of at this point of time?